The investment strategies of an individual or company can shift over time depending on changing circumstances. One emerging strategy that is proving effective for some investors, like pension funds, is a liability-driven strategy.
Liability-driven investing is an investment philosophy where an investor's liabilities are central to the investment decision-making process. In the case of a pension fund, a plan's liabilities are simply the very long-dated stream of benefit payments that the plan has promised to pay plan participants.
Aaron Meter, a pension investment specialist based in Chicago, says that liability-driven investing differs from the traditional total return asset-only approach.
The total return asset-only approach to investing that has traditionally been used by investors focuses on achieving a certain target rate of return on assets, whereas liability-driven investing still focuses on the long-term return on assets, but how it relates to the return on liabilities. So the measure of success is no longer did the assets achieve a certain return, it's did the assets actually outperform the liability return.
Meter says there are two primary reasons why pension funds are gravitating towards LDIs.
For quite some time, insurance companies have been using LDI to more efficiently manage assets versus liabilities. More recently, pension funds globally have embraced LDI as a best practice approach to asset allocation and risk management. There's really two primary reasons for that. One is the regulatory environment has moved in a direction where the benefits of better aligning assets and liabilities are much greater than they were in the past. Secondly, market volatility has been such where the asset-only approach to investing has caused significant shortfalls of asset returns versus liabilities. This is something that LDI could have helped avoid.
There are three fundamental beliefs that drive the company's LDI investment philosophy.
First, we believe to most efficiently control risk versus liabilities, you should split the portfolio into two components of assets. The first component of assets, referred to as the return-seeking component of assets, is focused on generating efficient returns in excess of the liabilities. The second component of assets, we refer to as the liability hedging component of assets, is focused on minimizing risk versus the liabilities. We also believe that within the liability hedging component of assets, what you buy in that portfolio of assets should take into account the size and composition of the return-seeking assets. Really what we're saying is you should create the liability hedging portfolio of assets in a total portfolio context. Lastly, we believe that within the liability hedging component of assets, you should also have flexibility to navigate between different types of liability hedging assets depending on the market environment and the investor's objectives.
A return-seeking asset component is primarily concerned with generating returns in excess of the liabilities.
In the case of a pension fund, by generating excess returns, you will improve the plan's funded status. This component typically holds assets such as equities, higher-yielding fixed income, and alternative investments. This component might also hold securities such as equity options, which are there to further control outcomes within this part of the portfolio.
The liability hedging component of assets has the objective of minimizing risk versus liabilities.
By doing so, in the case of a pension fund, it'll stabilize the relationship between assets and liabilities. Within this component, you're typically buying assets that mimic the performance of liabilities. In the case of a pension fund, this tends to be long-duration bonds and/or interest rate derivatives.
In the U.S., Meter says he is seeing LDI being adopted at two different levels.
We define Level 1 LDI adoption as implementation without the use of derivatives and without the use of an explicit liability benchmark. This is for plan sponsors who are really looking to take that first step in the direction of LDI, primarily using market-based long-duration fixed income. We define Level 2 LDI as implementation with the use of derivatives and often with the use of an explicit liability benchmark. This is for plan sponsors relative to Level 1 LDI adopters looking for a bit more capital efficiency and/or precision relative to their liabilities.
Meter says the company's view is that adopting LDIs simply means incorporating liabilities is essential to the investment decision-making process.
In that sense, we would argue that no matter what the market environment, it makes sense to adopt LDI as an investment philosophy. With that being said, we do recommend that when selecting your specific LDI investment strategy, you do take into account the current market environment. And in today's current low interest rate environment, we still see our plan sponsors taking steps in the direction of taking risk off the table, whether it be simply extending the duration of their current fixed income or utilizing more involved option-based strategies.
Within the pension space, there seems to be a trend towards more customization and explicit liability benchmarks, or what Meter refers to as Level 2 LDI adoption, and this will have two implications.
For liability hedging asset portfolios, it'll require those portfolios to target more explicit levels of hedging against liabilities. And then also within liability hedging portfolios, active decisions will need to be made more within a pension risk management context as opposed to a pure alpha generation context. From a broader market perspective, when you think about the future of LDI, it's our view that other investor types will embrace the outcome-oriented risk management spirit of LDI, such as defined contribution plans, individual investors, prepaid tuition plans, and even foundations and endowments.
To learn more about liability-driven investments, contact Aaron Meter at Legal and General Investment Management America or visit lgima.com.